3 qualities. Buffett only looks for 3. Intelligence, to break down complex problems. Energy, to work hard and stay the course. But the third one? That's the game changer. Integrity. Total honesty. And Buffett is adamant about this. Without that third quality, the first 2 become dangerous. Remember that. Think about it for 2 seconds. A smart and hardworking person, they can accomplish a tremendous amount. But wait, if they're not honest, their talents serve deception. Buffett says it bluntly: intelligence plus energy minus integrity equals monster. This person will do far more damage than a lazy and not so bright guy. And that's the whole trap. Markets are climbing, and then a curious phenomenon occurs. Investors gain confidence. Too much confidence. They look at the gains from recent months and think, this will continue. Some even borrow to invest more. Except that they buy when prices are at the ceiling. The worst moment. Exactly the worst moment. And when it crashes, the opposite. Fear takes control. The portfolio melts day after day. So we sell. We sell at the bottom. Years of potential gains, wiped out in a few clicks. Why? Because emotions dictate decisions, not reason. Never reason. Benjamin Graham, Buffett's mentor, had a simple method. Find companies trading below their real value, like picking up a $10 bill off the ground. You grab it, you pocket it. Easy. Except here's the catch. These bargains become impossible to find when you're managing a lot of money. Small portfolio? This approach works very well. But as soon as you manage millions, everything changes. Buying massively into a small company drives its price up immediately. Your advantage? Evaporated, before you can even profit from it. Buffett understood this. He needed another method, radically different. Invest in what you understand. Sure, but concretely, what does that mean? It means being able to project yourself, imagining where this company will be in 10, 20 years. If you can't answer that question, you don't really understand the business. And therefore, you're not investing. You're speculating. Period. A concrete example. Think of a major soda brand. In 20 years, people will still drink that soda. Same recipe, same habits. This is exactly the type of company that falls within your circle of competence. You can predict its future without being a financial expert, without complicated algorithms, just common sense. 2 types of financial mistakes exist. The first one's visible. You buy a stock, it crashes, you lose. It's quantifiable. But the second ones, the worst, are invisible. The opportunities not taken. Nobody counts what you could have earned. These errors of omission never appear on your statements, and yet they cost you a fortune. Concrete case. You know that investing early is crucial. You know that markets rise over the long term, and yet you wait. You hesitate. Each month of delay costs you compound interest. Over 30 years, tens of thousands of dollars gone. The enemy is not ignorance. It's inaction in the face of what you already know. Imagine a card, 20 slots. Each investment, a checked box. All 20 are filled? Game over. You can never invest again. This mental constraint changes everything. You think 10 times before acting. That stock tip from a colleague at dinner? Ignored. It doesn't deserve one of your precious slots. Never. 20 decisions for an entire lifetime. The evidence is clear. Real opportunities are rare. So when you find one, you strike hard. Not $1,000 with just your fingertips, a substantial amount. The best investors work exactly like this. They wait patiently. Then they take action massively at the right moment. When should you sell an excellent company? Only one reason should push you to do it. Only one. Management disappoints you. Leaders lose their integrity. Absurd decisions. Your interests as a shareholder ignored. In that case, sell without remorse.
but a high price in itself, never a sufficient reason. The other valid reason, the sector itself transforms fundamentally. Competitive advantages fade away. Demand collapses for good. Think about typewriter manufacturers. Your company loses its durable edge? Then yes, it's time to leave. Otherwise, keep your gems forever.
Intrinsic value, a simple idea. You add up all the profits a company will generate in the future. Then you bring them back to the present. Why? Because $1 today is worth more than $1 in 10 years, always. This is the foundation of any serious financial valuation. Remember that. Investing is an exchange. Simple. You give money now. In return, you hope to receive more later. That's it. Every investment decision comes down to this question. Does what you're going to receive tomorrow justify what you're sacrificing today? Yes or no?
A bond? A crystal clear contract. You lend $1,000 to a company. It pays you 5% per year for 10 years. Then it pays you back. Everything is written in black and white. You know exactly how much you'll receive and when. Zero surprises, zero uncertainty. With a stock, different story. The company promises you nothing, nothing at all. Dividends? Maybe. Prosperity? Maybe. Bankruptcy? Also possible. Your job as an investor, estimate these future payments yourself. Turn uncertainty into forecasts. The more reliable your estimate, the more rational your decision becomes. And that's the whole difference. Before buying a stock, one question, just one. How much money will this company generate in the years to come? Not its revenue, not its promises. It's cash, real cash. That's the only thing that matters. A company is worth exactly the money it can return to you someday. No more, no less. Be honest with yourself. Unable to estimate that future cash, even roughly? You're not investing. You're speculating. You're betting on the behavior of other buyers. Mind you, there's nothing wrong with speculating, but you need to know what you're really doing. Do you see the difference?